We are looking at common size statements analysis, common size statement analysis. So we had started looking at vertical analysis. So whereby we said under common size statement analysis is where you present the financial statements in percentages. So you identify a base, then of course you convert the other items in the financial statements to a percentage. So we said under the common size, in this case, we can have two ways. We can have vertical analysis and we can have horizontal analysis. So vertical here is where you identify a base. For example, in this case, in the income statement, the base will be the sales, figure. So that will be 100%. So the other items will be converted dependent upon the sales having to be 100%. If it is the balance sheet or maybe the statement of financial position, the total assets figure will be the 100%. Then of course the other figures you convert them on the basis of the figure of the total sales. Then of course on the side of, for example, the equity and liabilities, the total equity and liabilities will be the basis of converting the other figures into a percentage. So we had left at the point in time where we were looking at a simple illustration regarding how in this case you can be able to convert the income statement into a common size statement, an income statement into a common size statement for analysis. So we were to look at an example from the past paper. So I think I indicated I left it and I told you maybe you can be able to look at it by yourself, or alternative in this case, we can just be able to look at it very fast before in this case we look at horizontal analysis, So the question was in this case, I think August 2022, question number B, August 2022, if you can open that particular past paper. So it is August 2022. August 2022. August 2022. Question number 5B. Question number 5B. So I don't know whether you've been able to access it. So just confirm, because I've shared the past paper on the group there. So just confirm whether you can be able to access it. I'm not audible enough. You're not able to hear me? Is it for everyone, or David Kitonga says clear? So at least other people should be able to confirm whether I'm clear or not. So clear and audible. Yeah, so try to confirm. Maybe it could be your gadget. So just confirm whether you can be able to access that past paper, because I want us, August 2022, question number 5B. I want us to, we go through that question. Let me see whether I can be able to open it here. Let me see whether I can be able to open it here very fast. So I don't know whether we've been able to access the past paper. Just confirm whether we've been able to access it. Yeah, I think someone has already been able to share it there. Someone has already been able to share it there. So Jay has been able to share it there. So hope you can be able to access it. I hope you can be able to access it because mine is not opening. I want to be able to share it on the screen. So hoping you're having it. Mine is not opening there on the screen. So the question reads, so let's see. It will open here. I'm trying my level best so that it can be able to open here. Yeah, so the question is there, so hope you can be able to see it there. It reads, Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Dragon Limited have identified two potential entities targeted for a takeover. The directors believe that the shareholders of the two target companies would be receptive to the takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out a cross-sectional analysis of the financial statements of the two potential target companies which operate in the same industry and sector. The financial statements of the two entities are as follows. We have the statement of the P&L. Then, of course, you have, in this case, the statement of financial position, which has been indicated there. So required number one, a common size statement of profit or loss for the two entities for the year ended, that is 30th of April 2022. Then a common size statement of financial position for the two, that is 30th of April 2022. Then advise the directors of Dragon Limited on the best company for takeover, So here we'll be able to do what we call the vertical analysis. So we'll be able to represent these items or figures using the common size, and we'll be able to do what we are calling the vertical analysis. So because in this case, we haven't been given information regarding a number of years, so we'll end up having to do what we call a vertical analysis. So a common size statement with regard to vertical analysis to see how in this case, the performance is actually happening or occurring in these entities with regard to the base, which is the sales, and of course with regard to the total assets, and of course with the total current liabilities and actually equity. So what we do in this case, we can be able to represent, the statements. So that is a common size statement. So the common size statements for the two entities. So common size statements, the common size statements for the two entities. As at, I think 30th of April 2022, as at 30th of April 2022. So we have two companies here. We have Able Limited. We'll start with the income statement. So that is Able Limited. For Able Limited, And of course, in this case, we have SEDA Limited. Our amounts in this case are actually in shillings of thousands. Our amounts are in shillings of thousands. So we can have those two. Our amounts are in shillings of what? Of thousands. Our amounts are in shillings of thousands. So remember what he said in this case, when you're coming up with a common size statements analysis with regard to the income statement, then we'll take the sales or the revenue to be the base. So it means that in this case, our sales here will likely end up having to represent 100%. Our sales here will likely be able to represent what? 100%. Will likely represent 100%. So we have in this case revenue. So revenue in this case, our revenue in this case will likely be 100%. So there are those who will say they are not seeing the board. There are those who will say they are not seeing the board. So our sales in this case will be able to represent 100%. 100% for the two companies. 100% for the two companies. Remember, we are converting them into percentages. So we have in this case our cost of sales. So our cost of sales. So the cost of sales. So you can get the cost of sales in terms of percentage. In terms of percentage, it will be how much? So in this case, you can take your computation. In this case, you do your computation. It will likely be 66,500 divided by the sales, which is the base. That is 87,500. 87,500. Then you multiply by 100%. So what are you getting as the percentage? The percentage. I can see you're saying 76%. It is 76%. So 76%. What about for SEDA? What about for SEDA? What about for SEDA? SEDA, it is what percent? It is what percent? SEDA. What about SEDA? For SEDA is this one. That one you take in this case 114,800. You divide by, in this case, the total sales, which is actually, or total revenue, which is actually 140,000. Then you multiply by, in this case, 100%. So what are you getting? Suppose this one will obviously give us, in this case, the gross profit. So the gross profit. So the gross profit, if you get the difference here, it is actually 24%. Even if you still do the same computation of the cost of the gross profit here, if you convert to percentage of out of 100 sales having to the base, you'll still be able to get 24%. So this one is 82%. So that actually comes to 18%. If we compute now, in this case, that is distribution costs. So distribution cost you take, that is 1495 over 87,500 multiplied by 100. It is just the same procedure. So what are you getting as the percentage? Just the same procedure. In this case, you take, that is 1495 over the total sales, which is actually 87,500. You multiply by 100%. So you're getting 1.71. I don't know, we round off to one figure or we do to round off to two figures. We can round up to one figure. So let's say 1.7%. What about the other side for SEDA? So for SEDA, you take 2710 over 140,000. You multiply by 100%. So you convert, you get what? 1.9. It is 1.9. Yes, 1.9. Then the next item is actually administration expenses. Administration expenses. So for administration expenses, you are getting what percent? You are getting 1% for administration expenses. For administration expenses, you just use the same procedure. I can see you're saying 2.6. So 2.6 percent, 2.6%. What about for SEDA? What about for SEDA? Is it 2.6? Is it 2.6? Is it 2.6 or 3.3? 2.6 or 3.3? I don't know. 3.3%. Then this other side, you are getting 3.8. 3.8%. Should actually be 3.8%. 3.8%. Then when you get the difference there, you'll be able to get here 19%. When you get the difference here, remember you are lessing. You are lessing, you are lessing, you are lessing. You'll get 12.3. Should be 12.3. I think 12.3%. 12.3%. Then the next item in line is, so this is what the operating profit. So the operating profit. So remember, you can get the difference of the percentages, or alternatively, you can just take the profit itself over the total sales, then you multiply by 100%. You'll still get the 19%. You'll be able to get the 19%. Then the next item is finance costs. So finance cost. Finance cost, you are getting what percent? Finance cost. So finance cost, you take, that is, I think it is 875. 875 over 7,500 multiplied by 100%. So you're getting 1%. Yes, it's supposed to be 1%. 1%. What about for SEDA? What about for SEDA? SEDA. Just the same procedure. So 2.25%. We can round off to one figure. That will be 2.3%. So 2.3%. 2.3%. Then, so the profit before tax, you get the profit before tax. Profit before tax. So you get the difference there. You'll be able to get 18%. 18%. This one you'll get, is it 10%? 10%. 10%. You'll get 10%. Then the final item is income tax expense. Income tax expense. Income tax expense. So the income tax expense, you are getting what? Income tax expense. So you take 3150 over 87. Just the same procedure. Income tax expense, you're getting 3.6%. So 3.6%. What about for SEDA? What about for SEDA? What about for SEDA? You take 3.5 divided by 87,500. What about for SEDA? You are getting 2.5. Is it 2.5%? Yes, 2.5%. So this will be able to get 7.5%. This one will be able to get, is it 14.4%? 14.4%. So this becomes the profit for the year. So the profit for the year. Profit for the year. Profit for the year. So that is how, in this case, you'll end up having to determine or convert the profit and loss or the income statement into a common size statement under what? Vertical analysis. Under vertical analysis. Basically, it will be presented like this. It will be presented like this. So all the items, you use the sales or the revenue, sales revenue as the base of converting all the other items. So you can look at how, in this case, now you'll end up having to convert the balance sheet or the statement of financial position. So now in this case, we can look at, hope you've been able to capture this one. You've been able to capture this one. So you've captured this one. So the statement of financial position. Now we can be able to convert the statement of financial position. Just the same procedure, but now under the statement of financial position, we'll be using the total sales on the side of the total assets, on the side of current and non-current assets. Then also we'll be able to use the total equity and liabilities on the side of what? the equity and liability. So the total assets will be the base. And of course, now in this case, the total equity and liabilities will likely also be the best. So the common size statement. So the common size statement. Common size statement for the statement of financial position, for the statement of financial position as at is 30th of April 2022. So you go to your balance sheet, you'll be able to go to your balance sheet. So of course, now in this case, we have the two companies. So that is the able. So our figures, of course, they're actually in shillings of thousands. That is SEDA. Our figures are actually in shillings of thousands. They're actually shillings of thousands. So you can start with the non-current assets. You can start with non-current assets. So non-current assets. The non-current assets. So the first item under the non-current assets, it is actually property. It is actually property. Is it property, plant and equipment, or just property? I think it's just property. If you convert the properties to the percentage, what are you getting? Let's see whether you can be able to remember this, because you're having to say use the total assets. Use the total assets as the base. Use the total assets as the base. I can see you are saying J says 29.2%. 29.2%. Is it correct? Is it correct? Is it correct? Hope. Or correct. 29.2. I can see also T says. So you can be able to round off to the nearest figure so that you can have whole numbers there. Maybe in this case, you're saying 29.2. 29.2. Everyone is saying 29.2. Everyone is saying 29.2. So we can go with maybe what? We can go with maybe what? Maybe we can be able to round off to whole figures. Let's use 29, just 29%. 29%. What about this other side of SEDA? The other side of SEDA, I can see you're saying 15.8. So we can do 16%. 15.8. So that will be 16%. Then the next item is actually owned plant. Owned plant. What about the owned plant for able? The owned plant for able. The owned plant for able. The owned plant for able. 20.8. 20.8. So maybe we can do 21%. What about the other side of SEDA? The other side of SEDA for the owned plant. So the next item is right of use of asset. Right of use of assets. Right of use of asset. I can see you're saying 12.1%, so you can do 12%. What about the right of use of asset? Right of use of asset. So here you'll be able to get the total figure for the non-current assets. So the right of use for the asset, the right of use for the asset. So this one will be 0, so it will be nil because there is no figure there. And this one comes to a total of 50%. And this one will be 26.3. So we can say maybe just 26. I can see Gitonga is asking, what are you using as the base? You use the total assets as the base. So for example, now in this case, if you are converting this property, you can see the figure for the property there is 9,800. 9,800. And of course, the total assets we've been told that are how much? 33,600. So 9,800 over 33,600, you multiply by 100%. So use the total assets figure as the base. The total figure for the assets, I think you can be able to see it down there. It is 33,600 and of course 66,500. So that should actually be the best figure you're having to use, Gitonga. Hope we are together. 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 So this one is 26%, 26%. So if you do the total there, you're getting how much? That is 28. That comes to around 54%. So 54%. So we go to the current assets. We go to the current assets. So the current assets. Current assets. You go to the current assets. Hope Gitonga, you've been able to get the concept. Hope you've gotten 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 the concept. So the current assets, you have inventory. So inventory is which percent? Inventory. Inventory. You have inventory. Then you have trade receivables. Trade receivables. We have trade receivables. Inventory is a 16.7%, so you can do 17%. If you round off to a whole figure, that is 17%. 17%. What about for SEDA? What about for SEDA? For SEDA. For SEDA, you have trade receivables, and of course also we have bank as another item. 17.9, so that is 18%. That is 18%. And the trade receivables. For trade receivables, 21.9, so that is 22%. What about for SEDA? What about for SEDA? What about for SEDA? 26.8, so that is 27. So that is 27. If you round off, that is 27%. And the bank, so this one should be able to give us a total of 100%. So should be able to give us a total of 100%. What about bank here? Bank. For bank, 11.5%, 11.5%. 11.5%. 11.5%. SEDA 1.1%. So that's 1%, because this one will be 12%. So both of them should actually be able to give us, so this is the figure for total assets, which is the base, total assets, so which is actually what, 100%. So that is how in this case you'll be able to convert the side of what, the side of the non-current assets and of course what the current assets. Remember, you're using the total assets as the base, You divide all the other items, then you convert them into 100%, using the total assets as the base. Then you can go to the side of, in this case, the equity and liabilities. Equity and liabilities, you just continue. You can just be able to continue down here in your table. But now let me put the side for equity and liabilities. 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 So we have in this case equity and liabilities. Equity and liabilities. Of course, the first item there is ordinary share capital. Ordinary share capital. Ordinary share capital. Ordinary share capital. So ordinary share capital, in this case, you're having to be told the amount is 3.5. So you take 3.5. So you take 3.5, 100 divided by 36. 33, is it 33,600? 33,600. Then you multiply by 100%. You multiply by 100%. You're getting how much for the ordinary share capital? The ordinary share capital, that is 10.4%. So averagely that is 10%. What about SEDA? What about the side of SEDA? We have ordinary share capital, we have revaluation surplus. Revaluation surplus. Revaluation surplus. So this one is 10%. This other one is 10.5%. So that is averagely 11%. What about revaluation surplus? Revaluation surplus. We have revaluation surplus, then retained earnings, retained earnings. So revaluation surplus, 4.7, 5.2 and 4.7. 5.2 and 4.7. So that is averagely 5%. 5%. So what about retained earnings? Retained earnings. What about retained earnings? So retained earnings, 5.2. Retained earnings is 5.2. Jay is saying 5.2. So for retained earnings, you take the retained earnings figure, you divide by 33,600, multiply by 100%. 16.7 and 14.2, so that is 17%. And that is 16 point. So that is 17%, and of course 14%. So when you total here, you'll be able to get the figure for total equity, total equity. This one is coming to, I think, 32%. If you add the two, that is 32%. This one is 16, that is 30%. 30%. Then you go to the non-current liabilities. So non-current liabilities. So for non-current liabilities, the first item we have is lease liability. So the lease liability, yes, lease liability. So lease liability. They had a long-term lease, probably. They had a long-term lease. So this one is nil because there's no figure there. What about here? What about there? So this one is nil because there's no figure. Under able, there's no figure there. But what about now in this case for SEDA? For SEDA. What about for SEDA? So the next item is the 10% loan note. So 10% loan note. 10% loan note. So saying 22.1%. 22.1%. So that is averagely 22%. What about the 10% loan note? So for the 10% loan note, in this case, we have 15,750,000 divided by 33,600. So 15,750 divided by 33,600 multiplied by 100%. So that is for able. That is for able. Then for, in this case, the other one is 17,500 divided by the same amount. The total assets, that is 66,500. So 46.9 and 26.3. So that is 47% and 26%. So 47% and 26%. Then I think those are the only items. Then we have the current liabilities. The current liabilities. So for the current liabilities, we have the first item there. Trade payables. We have trade payables. So trade payables. What are the percentages for the trade payables? The percentages for the trade payables. The percentages for the trade payables. The percentages for the trade payables. Percentages for the trade payables. So I can see 13%. There's 13%. And what percent? So 13%. 13%. And 11%. 13% and 11%. 13% and 11%. So after trade payables, we have lease liability and current tax. Lease liability. Then, of course, you have current tax. The tax in the current year. It is not deferred tax, but it's the tax in the current year. So the lease liability is what percent? I can see you're saying 11%. Is it true? Is it true? Lease liability. So the lease liability. Nil. So the first one is nil because there's no figure there. So this one ends up having to be nil. What about this other side? The first one is nil. The other side is 3.7%. So this one is 4%. Then we have, in this case, current tax 8%. What about this other side for the current tax? This other side for the current tax. This one is 8%. Current tax here is 8%. What about for SEDA? What about for SEDA? 7%. 7%. If you do the total there, it should be able to give you the total figure for, so that comes to 100%. That comes to 100%. That comes to 100%, 100%. So that's why in this case, you prepare the common size statement or the vertical analysis, the common size statement, what you are referring to as what the vertical analysis, whereby you convert the items in the financial statements into percentages using the total sales figure or the total revenue figure as the base in the income statement, and you use the total assets and the total equity and liabilities to convert the items in the statement of what financial position, in the statement of financial what position. In the statement of what financial position. So of course, that is how you would have been able to do the Roman 1 and Roman 2. So Roman 3 in this case wanted you to advise the directors of Dragon Limited on the best company to be able to take over, on the best company to be able to take over, on the best company to be able to take over. On the best company to be able to take over. So you can be able to write, So from the, if you can be able to look at the common size statement we've been able to prepare with regard to the profit statement, then you realize if you look at able, the revenue in this case, in terms of profit is actually what, 14% of the total sales. And of course, now in this case for SEDA, the total profit in terms of sales is actually 7.5%. So overall, in this case, Able Limited seems to be performing better because it seems like in this case, there's a far much better utilization of resources in terms of realizing what profits in Able Limited. So if you look at the percentage of the profits, if you compare with the sales, the percentage is actually a bit quite high. And therefore, in this case, the performance in terms of translating returns to shareholders, in this case, with regard to Able Limited, is far much better compared to, in this case, what SEDA Limited. So it means that those profits that have actually been realized after tax, in this case, they'll end up having to do what? Dividend distribution. So they are far much better in this case to, for example, translate the resources into more profits for the shareholders in Able Limited than in SEDA Limited, because they can be able to say there's a almost double, 7.5% you compare to 14.4%. So for Roman 3, you can just be able to write from a profitability perspective, comma, Able Limited from a profitability perspective, Able Limited seems to be a better investment. 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 Because there is a better translation. There is a better translation of resources. There is a better translation of resources. There is a better translation of resources into returns. There is a better translation of resources into returns for the shareholders. There is a better translation of resources into returns for the shareholders. there's a better translation of resources into returns for the shareholders, 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 into returns for the shareholders. So I can be able to see, is it right to round off in an exam situation? So there's no problem to round off in an exam situation. So because probably in this case, some of the percentages you might have ended up having to get, maybe they have so many decimals this side. So it means that you cannot actually be able to write all the decimals here, but you can be able to round off the nearest figure. You can be able to round off, not all of them, but some of them. You might have realized there are so many decimal points after that. So no harm if you end up having to round off. As long as in this case, you do what a proper rounding off, of the figures, a proper rounding of the figures. So that's how you could have been able to answer this one for Ebo and Seda as per that particular sitting, as per that particular sitting. So I want us now in this case to try and look at what we call horizontal analysis. You can wind up on these analysis by looking at what we call horizontal analysis. Horizontal analysis, vertical analysis. But now we look at analysis. Horizontal analysis. Analysis. Horizontal analysis. So we can look at horizontal analysis under common size statements. How do you do horizontal analysis? Horizontal analysis. So when you talk about horizontal analysis here, this is whereby in this case you use there's a presentation of statements for a number of years. So there's a presentation of financial for a number of years. So you'll choose what the years will likely be the base of comparison. Will likely be the base of comparison. Maybe in this case, you can actually identify whether there has actually been an improvement from one year to another. So whereby you take, for example, financial statements for the year 2022. Then in this case, there are also those financial statements for the year 2023, then 2024. So you want to, for example, in this case, look at, in terms of, for example, revenue, if you compare the year 2022 and 2023, was there any form of improvement in terms of what may be revenue? So you will, for example, in this case, use the year 2022 results as what? As the base. Then, of course, in this case, try to convert using that base year, for example, figures, or for example, items in the financial statements figures, to convert the subsequent year, for example, performance into what percentage. So with this, then you can be able to tell whether in this case, for example, there was any form of improvement in terms of maybe the performance from one year to the other. Sometimes in this case, we end up having to refer to it as what? As a trend analysis. So you basically look at the trends in terms of performance from one year to the other, in terms of performance from one year to the other. So you can be able to write something about horizontal analysis before we look at an illustration or an example, just one paragraph or two about horizontal analysis before we look at an illustration or an example. Before we look at an illustration or example. So horizontal common size analysis, so you can be able to write something. So under this analysis, comma, each account, under this analysis, comma, each account, under this analysis, each account, under this analysis, each account value is expressed, under this analysis, each account value is expressed as a percentage, under this analysis, comma, each account value is expressed as a percentage over designated base year account values, as a percentage of a designated base year account values. So that you identify a particular year to be the best. So those values for that year will be the best. Full stop. This allows the analyst to see how the items value, this allows the analyst to see how the items value has changed over a duration of time. It is also known as trend analysis. 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 Also known as trend analysis. So this one has never been tested in the exam, but of course now in this case, you can be able to have an illustration. So you can do an illustration. It has never been tested in the exam, so, but we never know. Maybe this time it will be tested. So we can have an illustration. So illustration, have an illustration. Illustration. So you can be able to say, consider the following financial statements. So consider the following financial statements. Consider the following financial statements of ABC. Consider the following financial statements of ABC Limited. ABC Limited, and prepare horizontal and prepare horizontal common size statements and prepare horizontal common size income statement and prepare horizontal common side income statement for the year 2021 and 2022. So we can have the income statement here. So we have ABC Limited income statements, ABC Limited income statements. So you can have here the year 2021, then you can have here the year 2022. So of course our shillings are actually in thousands. Our shillings are actually in thousands. Then you can be able to, let's have these. So we can have that. Then you can start with the revenue. So revenue here. Revenue is can do 30. So that is the first item. Then cost of sales. So that gives you gross profits. Gross profit of 18 million. Administration expenses. Administration expenses. 1.5 million. Can have distribution expenses. $1.2 million. So if you less, it will give you earnings before interest and tax or 15. I think it's 15,300. Then finance cost, there is a finance cost or investment. Maybe you can say there's an investment income of 500. So that will give you earnings before tax, earnings before tax for 15,800. Then tax expense. Tax expense of 3 million. So that is 12,800. So these are the earnings after tax, earnings after tax. So you can also do the same for this one. So this one is 34 million. This one is 12,500. 12,500. That will give you 21,500. Then this one is 1.2 million. This one is 1.8 million. 1.8 million. Then this one is so it will give you 18,500,000. This one is 200. 200. Investment income is 200, so 18,700,000. Then the tax expense here is 4 million. So that gives you 14,700. So you can copy that. You can copy that. So these are the performance for the income statement 2021. These are the performance for the income statement 2022. 2022. 2022. So you can copy it. You can copy it. So if you're done, you can tell me done so that we can be able to now start doing the analysis. We can start doing the analysis. We can start doing the analysis. We can start doing the analysis. So we can start doing the analysis. So hope you are done. Hope you are done having to copy it. So so in this case, we are doing now in this case the horizontal analysis. Then ideally, what you're having to say that this one will likely basically be what will be the base year. So you'll basically be using 2021 as the base year to compare with maybe in this case the performance of 2020 to see whether in this case there was actually any form of what maybe improvement, or maybe in this case what a decline in terms of what maybe the performance, a decline in terms of what may be the performance. So here, here in this case, we can be able to take this one as, you can now draw another statement, and of course, make these ones to all of them be 100%. Maybe you can make all of them to be 100%. So these ones will be 100%. These ones will be 100%. These ones, all of these ones will likely be 100%. So 100%, then 100%, 100%, 100%, 100%, 100%, 100%. So that will be the 100%. So you can be able to use this one as the best. So if, what you mean by this, if you're using that one as the best, you'll be able to take 34,000 over 30,000 multiplied by 100%. So 34,000 over 30,000 multiplied by 100%. That other one will be able to take 12,500 over 12,000 multiplied by 100%. You just do the same. So this one is the best. This one ends up having to be the best. Then, of course, you see whether in this case there was actually any form of improvement in terms of performance or maybe decline if you compare what the two years. So the same case in this case with what gross profits, the gross profit. So you can be able to take in this case 21,500 over 18,000. You multiply by 100%. So I don't know, what are you having to get as the percentage here? What are you getting as the percentage here for the first item? 113%. So this one is 113%. What about this one? What about this other one of cost of sales? This other one of cost of sales. So that is 113%. 113%. So 113%. I can see you're saying 104%. So let's hope it's correct. 104%. 104%. What about in this case, the gross profit? The gross profit, I can see you're saying 119. 119%. 119%. Then 80%. So you're saying 80%. This one is 80%. 80%. 80%. 80%. 80%. What about this other one? After 80%, I can see 150%. And for EBIT, for the EBIT, 121. For the EBIT is 121. What about investment income? Investment income, 4%. 50%. The tax expense, tax, but that's I think 1% or 18%. What about in this case the tax expense? Is it 133? 133. Then the last item, yes, 115%. Get 1%. Yeah. There it was nice there. So that in this case, you would have been able to use 2021 as the base year. So you've made it to be there 100%. Then, of course, you're trying to compare with 2022. So you can be able to see there was actually an excess of 13% in terms of revenue. In terms of revenue for the year 2022, if you compare with 2021. So in this case, you can see like a trend. So of course, the trend here will be able to, for example, in terms of admin expenses, that decline 20% to 80%. In terms of, for example, in this case, the distribution expenses, there was an increase. If you compare 2021 as the base year, if you compare with 2022, there was an increase in terms of what the distribution expenses. What 150% percentage of what 150%. So it can give you like a trend in terms of the performance, of the different items or elements in the financial statements. And different items or elements in the financial statements. So in auditing and assurance, maybe you'll be told that this one can basically be what we call analytical review. Analysis. So what we call analysis. So you try and actually, for example, analyze the different elements in the financial statements and see what, for example, could be the variation, or maybe the trend in terms of what the expenditure, maybe the revenues. So the different items in the income statement or the financial statements, you can see there's some kind of like a trend. Maybe there was an increase, there was actually a decline. So like that, it just gives you like a trend of what is happening if you could using a particular year as the base year. as the base year. So maybe in this case, you would like, you can even, for example, include another year here, 2023, and still you use this one as the base year to see how was it, or maybe 2022 as the base year. Then of course you compare with 2023. How was it? An increase in the percentage, or there was a decline? So that will help you, for example, to be able to analyze the financial statements, So that is how, in this case, what common size analysis, what we call what horizontal analysis. So it is actually a bit different from vertical. Because vertical, you use this item revenue in the income statement as what? As the base, at the base. So if you would have gone to the balance sheet, then you would have just done the same trend. You're able to use the items in the balance sheet for the year 2021 as the base. All of them are 100%. We try to see whether in this case there was an increase in terms of percentage for the year 2022. So with that, you'll basically be doing the analysis horizontally. You know horizontal how you go. So horizontal is like this, but for vertical, it is like this, whereby you use, in this case, this item as the base, and you convert all the other items into percentages. It can give you some kind of like a trend that in this case you can be able to, for example, use to do what? Analyze. Remember, it is far much easy to, for example, analyze using what? Percentages other than figures. So figures are most likely not in this case to be able to tell you the trend very easily, but when you put them into percentages, then you can see some kind of like, in this case, what? A trend having to, for example, arise, having to, for example, arise, having to, for example, arise. So that is basically how you do what? The horizontal analysis, how you do the horizontal analysis, horizontal analysis, horizontal analysis, horizontal analysis. So I want us to move to another area. 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 So we can start looking at, in this case, published financial statements. So that is under International Accounting Standard, published financial statements, published financial statements, published financial statements. That is under International Accounting Standard number 1. International Accounting Standard number 1. International Accounting Standard number 1. So just from the word published, just from the word published, these are simply financial statements which are done, which are actually published. So in most of the instances, you must have heard, or basically in this case, you must have learned maybe somewhere else, that in this case, we have certain entities that in this case, when they end up having to prepare their financial statements, they have to publish them or make them become what? Public. Publish them or make them become what? Public. So their key financial statements that in this case will end up having to be published. For example, in this case, public entities could end up having to publish them or make them become what? Public. Become public. So we have, for example, in this case, what maybe the statement of comprehensive income, the balance sheet, statement of changes in equity, the cash flow statement. And of course, now in this case, amongst those items that will likely be included in the published financial statements will be what we call what? The notes to the financial statements. The notes to the financial statements. So there'll be a set of financial statements that in this case, that will likely be published or be made what? Public. As these financial statements are having to be published, then in this case, they're supposed to be published in accordance with what? International Accounting Standard number 1. International Accounting Standard number 1. So of course, there are those items that in this case, that normally you end up having to include them in the financial statements. But in this case, when you are preparing them as an accountant within what? The company, within the organization. But when you want to make them public, it means that there are certain items that you may not actually end up having to make them what? Public. So now in this case, there's like a format that in this case must actually be adapted when these published financial statements are having to do what? Are having to be presented out there. They're having to be published out there. For example, what you'll be able to discover or realize, when in this case we talk about published financial statements as we go on with this particular topic, it is that when you talk about, for example, the expenses, some of them end up having to just do what? Be accumulated together as what? Maybe administrative what? Expenses. So the way in this case you normally used to, for example, breaking down all the expenses and you present them in the income statement, when you end up having to publish, then in this case, according to IAS number 1, then you must be able to accumulate those expenses that are, for example, concerning administrative activities. You put them what? Together. You put them together. An item such as, for example, the cost of sales, you have to, for example, compute it separate and in this case, eventually do what? Put it together so that in this case, can present where? In the statement of comprehensive income to be published, in the statement of comprehensive income to be published. So it's just like the normal preparation of financial statements. In this case, there are a few differences as to why in this case you're supposed to present financial statements. And that is what we're going to be able to learn about in this case under what? The published financial statements. Remember, this topic is mandatory. It doesn't actually miss in the exam. So it is very important that you'll be able to comprehend what to happen in this particular topic. So we have group accounts, and of course, we have this one. Very important to understand in this case what is happening in this particular topic. So just to be able to introduce, before you even go into deeper details about how you do the computations of preparation of the comprehensive income or the balance sheet or statement of financial position and other financial statements here, then you can be able to write. So this is a set, what are published financial statements. This is a set of summarized. This is a set of summarized. This is a set of summarized. I can be able to see sound. I can be able to see sound. Is it okay now? Is it okay now? I can be able to see sound. It is better from this end. So I can see Jay is saying it's better from this end. Is it any better, Gitonga? I can see Gitonga was complaining. Is it any better? Is it any better? I have been breaking for around 30 minutes. I've been breaking for around 30 minutes. You can see Emmanuel says iko sawa. Emmanuel says iko sawa. But we can go on. So you can be able to write, it is a set of summarized financial statements. It is a set of summarized financial statements to be published by a company. It is a set of summarized financial statements to be published by a company. To be published by a company. To be published by a company. It is a set of summarized financial statements to be published by a company. To be published by a company. It is a set of summarized financial statements to be published by a company. It includes the following. It includes the following. It includes the following. So number one, we have in this case what we call statements. Statement of comprehensive income. Statement of comprehensive income. Number two, we have statement of financial position. Statement of financial position. Number three, statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Then you have in this case number four, cash flow statements. The cash flow statements. Cash flow statements. The cash flow statements, but this one is normally also addressed in another standard. It is IAS number 7. It is addressed in another standard, IAS number 7. We'll be able to look at how you prepare them. Then in this case, you have notes or disclosures to the financial statements. Disclosures to the financial statements. Notes or disclosures to the financial statements. Notes or disclosures to the financial statements. So in this case, when you talk about the statement of comprehensive income, quite obviously, I think you know at this particular point in time. So this one will be able to, for example, indicate to you how much has actually been made as an income in terms of, for example, the profit after tax, the retained earnings, for example, after distribution of what may be dividends. Then in this case, when you talk about statement of financial position, then in this case, it indicates the financial strength of the company. So financially, what is the strength of the company in terms of, for example, its availability of assets? And for example, what are the liabilities that are actually, for example, in place? When you talk about the statement of changes in equity, this one will be able to indicate the wealth of the owners. The wealth of the owners, whereby basically it deals with the equity part. It deals with the equity part. For example, in terms of the shareholding, were the owners able to buy any shares within the year? They contribute to the capital. In terms of, for example, in this case, having to raise capital in terms of, for example, maybe borrowing it with regard to maybe debentures. Did the company, for example, sell or any debentures to raise capital? So it will indicate how the capital of the company is changing over the year. Then in this case, the cash flow statement, how is the company actually performing in terms of of cash flows? So it basically deals with the cash. Then we talk about notes or disclosures to the financial statements. There could be those elements that have actually been presented in these financial statements. And of course, as the accountant or the person in charge of preparing the financial statements, you want to elaborate on them. So you'll be able to elaborate on them by including in your set of your published financial statements, what we call the notes or disclosures to the financial statements. There could be certain elements here that you want to make the use of these financial statements to better understand what has been presented up here. Should, for example, in this case, include in the set of the financial statements what we call the notes or disclosures to the financial statements. The notes or the disclosures to the financial statements. So in this case, this can include, i.e., what can be included in the notes to the financial statements. Maybe in this case, you're going to be able to talk about the accounting policies that have actually been applied. The accounting policies that have actually been applied. The accounting policies, you can be able to talk about in this case, maybe in this case, you can be able to talk about in this case, the compliance, whether there is compliance, whether there has been compliance with relevant frameworks, with the relevant reporting frameworks, relevant reporting frameworks. Then, of course, you can be able to include here other reports. In the notes, you can include other reports, e.g., you can include here what we call the director's report. You can include, for example, in this case, what we call auditor's report. The auditor's report can also be attached. Auditor's reports. You can include, for example, in this case, corporate governance reports, etc. So there could be any other reports that in this case you feel like in this case they are necessary for a better understanding, for example, of these financial statements. For example, in this case, when you include the auditor's report here, it will be able to, for example, indicate whether the financial statements have done what have actually been fairly presented, presented. They represent a true and fair view about the affairs of the company. So that's why in this case, in the notes, all those other attachments, then you can be able to attach this kind of for example, in this when we talk about director's report, it, for example, in this case, be indicating how the company has actually been able to perform, and of course, what are the future prospects about what the company. So there are other information that are actually quite necessary for the user who's using this set of financial statements to be able to get a better understanding, to be able to get what a better understanding. So, and of course, that's basically will be the components of what you're calling what the published financial statements. Published financial statements. That is basically what will likely be contained in the published financial statements. So of course, now in this case, there's something I've been able to mention that it's just like the normal way of having to prepare financial statements, which you've gotten used to. But now the ones that are having to be published, there are those special considerations that you must actually be able to put in your mind as you're preparing them to be able to publish. The special considerations you must be able to put in mind as you're preparing to do what? Prepare published financial statements. As you're preparing to prepare what? Published financial statements. These are some of the key areas that in this case you must actually be able to put in your mind as you are coming up with, for example, a comprehensive income or a balance sheet, a comprehensive income or a balance sheet. So special areas in preparation, of published financial statements. Special areas in preparation of published financial statements. Special areas in preparation of financial statements. So number one of so much importance is in this case, how do you recognize inventory? So recognition of inventory. Recognition of inventory, inventory. So how do you recognize what inventory? So what you can be able to note about this, so inventory, or what you call what closing stock. So inventory, or in this case, what you are getting used to is closing stock. So in this case, inventory will be valued at the lower of cost versus the net realizable value. So it will be valued at the lower of cost. It is valued at the lower of cost, vis-a-vis the net realizable value, Sometimes in this case, you've gotten used to this one, you just call it NRV. And this, of course, is actually in accordance to International Accounting Standard number 2, on inventory. Always in this case, when you're valuing inventory, you should be able to value it at the lower. You compare the costs of acquiring that inventory. You compare with what you can be able to realize as a value from that inventory. You take the lower of the two. For example, in this case, if you ended up having to acquire an inventory at a cost of, let's say, for example, 70,000, and what you can be able to realize out of this inventory, when inventories, those are the items you are selling, the items you're having to sell. So if in this case, you can be able to realize out of that inventory only 65,000. Most obviously, in this case, when you purchase items, you are expecting to be able to sell them at a profit. But there can be a number of factors that could end up having to cause you won't be able to realize even the amount you purchased those items for. You'll end up having to dispose them off at a lower value. If that is the case, when you are valuing this inventory, when it is going to the balance sheet, or for example, when you're calculating in this case what the profits in the P&L or the income statement, you'll take 65,000. This is NRV, because you're having to take the lower of the two, the lower of cost, and the net realizable value. So you'll be able to take 65,000 as in this case, the value, for example, to determine what could be the closing inventory to be used in the balance sheet, and of course, now this is to be used when we are determining the cost of sales. Then number two, other thing to be able to take note of is how do you recognize provisions? Recognition of provisions in published financial statements. Recognition of provisions. So provisions should be recognized. Provisions should be recognized. Provisions should be recognized. Provisions should be recognized if should be recognized if the probability, provisions should be recognized if the probability of occurrence, is very high. If the probability of occurrence is more than, let's say more than 50%, exactly more than 50%, more than 50%, more than 50%. So sometimes in this case, you've seen when you're preparing, for example, the income statement, you do what? Provision for bad debts. You do what? An allowance for bad debts. Provision for bad debts. An allowance for what? For bad debts. Or for example, in this case, you are expecting there'll be an outflow as a result of what? For example, certain issues surrounding what? Maybe the operations of that kind of what? Maybe a company. We can give an example. For example, there's a legal suit before the court. There's a legal suit before the court whereby the company has actually been accused. And in this case, when you consult the lawyer of the company, he's having to say that in this case, there's a high chance there'll be a ruling or maybe determination that will actually occur maybe on 2nd of February, 2025. But according to the lawyer's advice, the company is most likely in this case to be penalized. So he has given you, like in this case, almost 50% probability that in this case, the company is going to be penalized or to be fined out of what? The verdict out of that court suit. So it means you have to do what? To make a provision. So you'll have to recognize it as part of what? The expenses. Whenever you're, for example, you're coming up with what? The income statement. So when you're in this case recognizing provisions, if there's a high chance of occurrence of it, then you must be able to provide for it in the books of accounts. Then number 3, another item, when in this case you are coming up with the item for cost of sales, so the figure in this case will likely basically you compute it separately. Then of course, in this case, you place the figure in what? In the income statement. You don't actually, for example, go with the option whereby we normally put in the income statement, opening stock plus purchases minus closing stock, carriage inwards. You don't do that. You do it at least as a separate working. Then of course, in this case, you plug it into the income statement as one figure. As one. So published financial statements, you don't actually put everything. So hautoboi siri yote kwa sababu in this case, they are going to be published out there. So in this case, you'll end up having to, for example, compute the cost of sales as one figure. And of course, in this case, do what? Plug the figure into what? Into the income statement, into the income statement. So for the cost of sales, expenses under income statement, we can just be able to say expenses under the income statement, will be categorized into the following classifications. You'll be able to classify them like this. So you'll be able to classify them like this. So you'll be able to have, for example, cost of sales. Cost of sales will be one figure. So you don't actually do the normal way we do it. Cost of sales. Then administrative expenses will be one figure. Don't actually go for the option of having to divide electricity separate, depreciation separate. So we'll have to bunch them together as administrative expenses. Then we plug the figure into the published financial statements. Selling and distribution. Maybe there were expenses regarding distribution of goods. Selling and maybe the commission to salesmen, like that. You plug them as one figure. Finance costs. So that's why in this case, in most of the income statements, you're having to see finance cost. So you'll have in this case a figure for the finance cost, which in this case will compose of interest expense. This one will be made up of interest expense, and of course, now in this case, maybe interest expense or interest expense on loan, or maybe it can be on redeemable preference shares. redeemable preference shares, etc. Redeemable preference shares, etc. amongst other items, So these are the key things to be able to take notes, that the figure for the cost of sales, you compute it separately, then you just include it as one figure in the income statement. Administrative expenses, you bunch them together as a separate working, then you include them in the income statement. Selling and distribution expenses, you compute them separately as one figure. Finance costs, if you have, for example, interest on loan, interest on what, so you basically compile them together as finance cost. As finance cost, when you're preparing what? The published comprehensive income statement, the published comprehensive income statement, the published comprehensive income statement. So these expenses, that is how basically you'll be able to deal with them. Then when you're preparing the balance sheet, so sometimes in this case, we've been able to see that we do what? Non-current assets, then we break them down. So now in this case, what happens under published financial statements for these items in the balance sheet, like for example, land, like for example, buildings, you just basically compute one figure we refer to as what? Property, plant, and actually equipment as a separate figure. Then you bunch them in the statement of what? Financial position as one figure. So you don't actually, for example, in this case, do what? Include them the normal way. In this case, you're having to do regarding preparation of what? Of the balance sheet. So you can be able to indicate number 4, which is actually also very important for the balance sheet. When you're talking about, in this case, items such as land, buildings, all those ones, you compute them together as property, plant, and equipment, and you indicate one figure in the statement of financial position. Statement of financial. So the PPE, the property, plant, and equipment, is recognized. Number 4, the property, plant, and equipment is recognized. The property, plant, and equipment is recognized as a single figure, as a single figure under the statement of financial position, under the statement of financial position, under the statement of financial position. So it is actually recognized as just one figure under the statement of what? Financial position, under the statement of financial position. Then there's something we learned about in this case under income taxes. Income taxes, if you can be able to recall, we learned about in this case what? The current tax, and of course now in this case what? The deferred tax. The deferred tax. So in this case, the deferred tax in this case will be recognized as what? As a long-term liability, because now in this case we said for deferred tax is simply tax that will likely be claimed from the company in future. But the current tax is simply that tax you're having to pay in the current year. So the current tax in this case will be a short-term liability. But for the deferred tax in this case, it will likely be what? Be a long-term liability. So you must be able to take note that in this case, under published financial statements, so deferred tax, we have the deferred tax, which we learned about it. If you can recall this topic, we've learned about it, whereby we say deferred tax, it is tax claimable from the company in future. It is tax payable. It is tax payable. It is tax payable by the company. It is tax payable by the company in future. It is tax payable by the company in future. Tax payable by the company in future, or recoverable from the company in future. In future, arising from what we called what? Arising from what we refer to as what? Arising from temporary differences. Temporary difference. I don't know if you can be able to recall how we are coming up with the temporary differences. You need to go back to that topic and try to remind yourself. Temporary, whereby we are taking the carrying amount minus the tax base. Then to get the deferred tax, we took 30% of the temporary difference to get the deferred tax, or the tax to be claimed in future. So therefore, in this case, it is recognized as an non-current deferred tax. It is recognized as an non-current. It is recognized as a non-current liability. is recognized as an non-current liability. It is recognized as an non-current liability, So what will happen in a question, you'll likely be given the deferred tax in the trio balance. So that basically will be the opening figure for the deferred tax. Then maybe in this case, in additional information, you'll be told that there's another figure for for deferred tax. You must be able to, for example, in this case, compute and actually identify whether there's any increment in deferred tax or there's a decline in the deferred tax. Because that is what you'll end up having to utilize in terms of having to come up with the income tax expense, to go to the income statement, the income tax expense to be able to go to the income statement. So remember, when we're talking about, in this case, income taxes, we say there are two forms of taxes here. We can have the current tax and we can have, in this case, the deferred tax. So if in this case, you want to get the tax expense, so the tax expense in this case to recognize in published financial statements, the tax expense will likely be composed of in this case, the current tax. So the tax expense is made up of two elements, The tax expense is made up of two elements. The tax expense is made up of two elements, and it will be determined as follows. It is determined as follows under published financial. So it is determined as follows. So you take as follows. So of course, you'll be given the current tax. You'll be given the current tax. So the current tax, you take the current tax. Then in this case, you add deferred tax. So it can either be an increment or it can be a decrease. It can be an increment or a decrease. If it's an increment, you'll end up having to deduct. You'll likely end up having to add. You'll add so that you can be able to get the total tax expense. But in this case, if it is actually a decrease, it's like an income. So you'll end up having to less. Then, of course, you'll be able to get the tax figure in this case, for example, include in the income statement. In short, what you're having to say, you'll see in the trio balance, you'll be given balances. In the trio balance, you'll see on the credit side, because that is at the start of the year, maybe you've been given, for example, a deferred tax of, let's say, for example, in this case, 120. To get the tax figure in this case, for example, include in the income statement. In short, what you're having to say, you'll see in the trio balance, you'll be given balances. In the trio balance, you'll see on the credit side, because that is at the start of the year, maybe you've been given, for example, a deferred tax of, let's say, for example, in this case, 120. Let's say it is in million or maybe 1,000, 120,000. Then in the additional information, you'll be told the deferred tax by the end of the year. The deferred tax by the end of the year, in the additional information, the deferred tax by the end of the year was actually how much? 130 million. It was actually 130 million. 130 million. So it means the opening balance for the deferred tax was 120. But during the year, there was an increment. They incurred more in terms of the deferred tax. So therefore, in this case, it was having to increase the tax expense. So for that year, they incurred more 10 million. So in this case, if the current tax was 20 million here, they incurred more of deferred tax, and therefore it is having to do increase the tax expense. So you'll be able to add. But if you are told in this case, the deferred tax by the end of the year was actually how much? Not in this case 130 million, but it was actually how much? 105 million. 105 million. It means that in this case, there was a decline on the tax to be claimed in future. And therefore, that is like an income. It's like an income. So therefore, in this case, you'll do you less from the tax expense. It'll end up having to reduce the tax expense for the year. So you'll be able to less. So if there's a decline during the year in terms of deferred tax, you less. If there's an increase, it means the company is having to incur more in terms of an expense of deferred tax. You increase because it will increase the tax expense. So that's basically in this case how you determine the tax expense. You'll be told in the questions, you'll see in the trio balance, there's a figure given for deferred tax. By the end of the year, you are told the deferred tax in this case is how much? 105 million. And of course, this one is the one in this case you're having to say, you'll be able to recognize as what? As a non-current liability. This one at the end of the year. But of course, you have to compare with what was there at the, to know whether in this case, there was either an increase or maybe what a decline. If there's an increase, it means the company is incurring more for the tax to pay in future. It is overburdening itself even more by a particular amount. So that increase is a decline. It means that in this case, the company is gaining because that tax they were supposed to pay in future, it has ended up having to reduce. The claim has reduced. So they are no longer having to claim from them. So it means that in this case, you do what? You reduce it. You actually basically reduce the tax what expense. You reduce the tax what expense. So that is basically how in this case you determine what the tax expense when you're having to determine what the published financial statements. Then another item that is actually of so much importance, So the components of the comprehensive income will actually include the components of the comprehensive income. So there'll be other comprehensive income, we have what we call other comprehensive incomes. So other incomes apart from revenue will be recognized as other comprehensive what incomes. So other incomes apart from revenue. So other incomes apart from revenue, will be recognized as other comprehensive, incomes, in the income statement. This is in the income statement. This includes what are these incomes? That in this case, you'll bunch one figure. So you won't, in this case, for example, after maybe the gross profit, you start putting incomes like the way you do, maybe discount received, maybe rental income or those other things. So you basically just compute them separately as other comprehensive incomes. Then you plug one figure in what? In the income statement. Because that is basically what is required under IAS 1 if you are intending to do what? Publish your financial statements. Usitoboe siriote. You just basically put out there what is actually firm so far as what's necessary to be relayed out there. So these include, for example, revaluation gains on assets, revaluation gains. When you talk about revaluation gains here, you might have ended up having to revalue assets. And therefore, there was actually what? A gain. There was a gain. For example, in this case, land is normally done what? Revalued. So there can be a revaluation what? Gain. Gain. Then foreign currency. There can be foreign currency translation differences. There can be reimbursements, e.g., for example, in pension plans, reimbursements in pension plans, unrealized profits, on assets, unrealized profits on assets available for sale. Unrealized profits on assets available for sale. So these are basically part of the other comprehensive incomes that you could end up having to realize, that in this case will be included as part of the income statement But of course, you'll be able to compute them together. Then in this case, you just plug one figure of other comprehensive. Once we start preparing them under an illustration, you'll be able to see other comprehensive incomes as what? As one figure. So you compute them separately, then you just plug in one figure. You just plug in one figure. You plug in one figure. You plug in one figure. So those, I think, are the main areas of concern. Those are the main areas of concern regarding now, in this case, how you likely end up having to do what? Deal differently with published financial statements compared to how, in this case, you end up having to present what? Other financial statements, So you can look at, there are a number of questions. Almost each and every sitting, there's normally a question for this particular topic, published financial statements. But now in this case, you can be able to look at this one. Just look at this one as November 2016, which we'll be able to start with. We look at around 2 or 3 questions. November 2016, question number 2. You can just look at it, just look at it, but that is what we'll be able to commence from. So November 2016, question number 2, and of course, you'll be able to see what you are trying to talk about here, how it is actually presented, or how you come up with those figures. Then eventually, in this case, you do what? You prepare your comprehensive income or statement of changes in equity, then the statement of financial position, how you basically end up having to develop it as per the requirements of published financial statements under IAS 1, under IAS 1, under IAS 1. So I think we can end there unless there's any question. Unless there's any question, let's end there. So we'll be able to pick up from there. With that, we'll start with this question, but you can just have a look at it. Just have a look at it. We'll be able to start with that particular question, and we see how, in this case, you present what? Published financial statements, how you present published financial statements. So when will be the next class? When will be the next class? So of course, the next class is tomorrow. The next class is tomorrow, but I'll come in. I normally come in on Tuesday and Friday. Tuesday and Friday, because that is when I normally come in. So we'll meet next week Tuesday. Next week Tuesday is when we'll be able to continue with published financial statements. We'll be able to continue with published financial statements. Can you be teaching all the classes of FR we have? So I can see Gitonga is asking. So the problem now in this case, some of the days I'm having other classes. So I'm having other classes, so I don't know how I'll be able to divide myself, but let's see what will happen. Let's see what will happen. Because some of the days I'm having another class. Some of the days I'm having another class. So, but let's see what will happen. What will happen? What will happen? I can see someone is saying it's my first class. So we'll teach tomorrow. Who will teach tomorrow? So I'll consider it. So I'll be able to consider it. So let's see what happens. Let's see what happens if I can be able to divide myself. Let's see. Let's see. Yeah, so I think we can end there. So have a good evening. Start enjoying the weekend. Start enjoying the weekend. Start enjoying the weekend.